Hey, what's going on? Welcome back to part 2 of this multifamily underwriting series. Now, if you're just stumbling upon this video and you haven't watched part 1, go ahead and pause this video, click the thumbnail right here. That way you can go back to part 1 and have a complete understanding of the framework or the foundation to how we underwrite deals, and then jump back into this video because it can get confusing if you go through them out of order. But if you just got done watching part 1 and you're ready to go from theory to actually start doing, this is the video for you. And the reason I say that is because we're about to jump over to the whiteboard. I'm actually going to show you the physical property that we just closed on for $3.9 million, 28 units in Ocala, Florida. So that way you can actually see the property, you can see the business plan that we're implementing today, and then we're going to move into underwriting the deal on the whiteboard. Now, the reason I'm choosing the 28 unit deal is because this should serve as a really good baseline of what a home run deal might look like. And as always, if you find any value throughout today's video, all I ask is make sure to drop a like, a comment, and most importantly, make sure you subscribe. So let's go ahead and let's jump over to the whiteboard. So moving right into the deal itself. So this property is called the Villas at Stone Ridge. It's in Ocala, Florida. You can look it up. It's now owned by TDR Community Fund 1. That's the cool thing. You can't fake anything in real estate. And so I just want to show you really quick the actual property and why we bought it. Number one, the guy was forced to sell. He was in default. Like, this is the perfect time to be buying multifamily deals because of the interest rate environment, everything happening. So he was in default. He needed to sell, and we got it at a ridiculous price because of it. And beyond that, the deal itself has a ton of character and it has a ton of upside, over $300 of rent increases. So this was the original condition. We've already painted it since. The roofs needed to be replaced right here, and then this ugly green looking color, we've replaced it with a much nicer gray and blue color. So again, in value add investing, we're going in, we're taking the current interiors that look like this and we're renovating it to look like this, and because of that, we're able to rent it at $300 more. Same thing with the exteriors. We're going from green to a gray and a nice blue color. It looks fantastic. And then doing the roofs, adding a dog park, and then a pavilion area because there's 7 acres of land. And all of these units are 2.5 bedroom townhomes. So it attracts small families and it has a ton of character. All right, so the very first thing we're going to look at is how many units is it? It's 28 units. We purchased the building for $3,925,000. That was the purchase price. So about 140 grand a unit. We got a $2.9 million loan on it, and then we ended up raising another 500 grand from investors to actually do the renovations itself to the property and then have some reserves as well. So all in all, it was a $3.9 million transaction, $2.9 million of debt, $1.1 million to close the deal, and then another 500 grand we raised to do the project. So all the way in, about $1.6 million of equity that we raised from investors. All right, so step number 1 in underwriting the actual deal, referring back to the framework video, the first thing we're going to be doing is solving for the current takeover NOI, or the existing income that we acquired with new ownership expenses and all that fun stuff. So first thing we're going to do is we're going to take the number of units, which is 28, we're multiplying it by the average in-place rent. This is what is existing right this second, and it came off of a rent roll that the seller provided to us. So average rents are $1,350 that we're collecting every single month, and so we're going to multiply it by 12 months in the year to figure for our gross potential income. So if the building was 100% full every single month and everybody paid on time, we would collect $453,000 a year of gross income. But we all know we're not going to be 100% full throughout the entire year. So we're going to go ahead and take out a 5% vacancy factor, and we're going to underwrite the deal to 95% occupied. And after doing so, you get $430,000 of effective gross income. So after we take out the vacancy factor, because we're not going to be full 100% of the time, especially when we're renovating units. So we have $430,000 of gross income, and what we're going to do next is we're going to take out the expenses, and we're going to use what's called an expense ratio. So generally speaking, and this is definitely market to market, so this is only really to Florida, Texas, high property taxes and high insurance states, generally you're going to be between 40 and 50% of all of the income that you collect at the property is going to be what it costs to operate the deal. And so on this property, it was about 40% of the total income was allocated towards expenses. And right here, there's 2 things you can do with it. You can go the long way. You can take $430,000 and multiply it by 0.4, so you can figure out for what the estimated expenses actually is. But if you're like me and you want to save time, you can just take the inverse of whatever this expense is and solve for your NOI just by doing $430,000 $30,000, multiply it by 0.6, and you'll end up solving for your NOI. And so after doing so, you end up finding that the NOI is roughly $260,000 that we are acquiring at the property. This is our day one income. Now, moving into the next step, we have to solve for how much upside there is at the property. And so to accurately do this, we'll show you into the next video on how deep we go on our rent analysis. To sum it up very quickly, we do a rent comp analysis of all of the existing properties nearby, and this is where we discover what our actual business plan is going to be. For instance, putting in-unit washer and dryers in the units for us, because it's small families and they want washer and dryers, is a big value add to the property. And also the exterior professional management. This is where all of the money is made in the business. And so after doing our rent survey, we identified that we could take the rents from $1,350 to about $1,650 over a 1 to 2 year period. And after doing our analysis, after we did the exterior renovations and then renovated the inside of the units, we could get a $300 rent increase at the property. So rents would go from $1,350 to $1,650. So this is how I'm solving for my future net operating income so I can figure for my future value. We're going to take 28 units and multiply it by $300 of a rental increase, because we're not really adding new expenses to the property. We're just increasing the lease amount from $1,350 to $1,650. So 28 times 300 times 12, you end up getting about $100,000 of additional income that the property will produce. And all I do to keep it very simple is I take the current NOI that we bought, which was $260,000, and I add the additional income to it, because most of it is actually going to hit the bottom line. So 260 plus 100, our future NOI in this case would be $360,000. And now going into step number 3, almost the last step, we solve for the future value of the property by simply taking your future NOI and dividing it by what's called an exit cap rate, or whatever you think interest rates are going to be in the future. You typically want to be more conservative and be wrong in the good way, meaning you project interest rates are here and you actually get to sell for a lower cap rate and make a bunch of more money. So in this case, we're going to take $360,000 and divide it by 0.06 to come up with the future value of the property. And by doing that, you find out that the future projected value is about $6 million. So an investor is willing to come in and pay us $6 million in the future if he's paying a 6% cap rate for $360,000 of NOI. And we got there by buying 260, renovating it, and increasing the net income from 260 to 360. And now moving into the last step, which is solving for your returns and making a decision. The number one number you need to pay attention to is the all-in invested equity that you have in the deal. The way that you finance this deal will dictate how much money you bring to the table. I'm telling you, if you just pay attention to this step, but more importantly, the equity, things will start to click for you a lot faster than it did for me. And just to show you where all the money goes and how much everybody makes, because I know everybody wants to see it, is we sell the building for $6 million. I am purposely leaving out closing costs just to simplify this. Do not kill me in the comments. We're going to pay off the loan for $2.9 million, and you see ROC, this stands for return of capital, meaning I'm sending back all of the investors their initial capital, and then what's left over, which in this case is $1.5 million. This is where a profit split comes in. All right, so the last piece to the puzzle, which is the investor returns net after profit splits. On this specific deal, it was a small deal and it's a quicker hold period. On my larger stuff, we've done 80-20. On this one, we're doing a 70-30 profit split, meaning 70% of the profits go all the way to the LP, or the completely passive investor. They just write a check. We send them distributions every single month on the 15th, and we do all the work. And for doing so and making it passive, we take 30% of the profits. In this case, if you take 70% of the $1.5 million, it's $1,050,000 to the LP, and $450,000 to the general partners, which we'll go into in a second. And then we have this big equity number that I told you at the very beginning of this. $1.6 million is a very important number to know, because this is what dictates returns. So if you take $1,050,000 and you divide it by $1.6 million, it's a 65% profit, or a return on investment. We held the deal for 3 years. I think we could do this in 18 months or less, but we're going to underwrite it to 3 years anyways. And then that would mean we're at a 22% return on investment, or annualized return on just the appreciation. We're paying investors between 6 to 7% per year that were in the deal as well. And then for us doing a fantastic job, this deal was actually sourced from a member in our inner circle named Noah Sanders. So So he found the deal, he brought it to me, we negotiated with the broker, I raised all the money, and we did this as a TDR community fund deal. So we've documented the entire process and shared it with the inner circle. So that's why we have a couple of partners in here, but at least 150 to 200 grand of a score for all of us in 18 to 36 months. And that's pretty much it. After we got to this point in the deal, this clearly fits our criteria. We like it. So the next step in this process, after we get done through pen to paper, because this is really important to understand, and that's why we're going down this way from a very high level all the way down to the nitty-gritty detail, because you need to understand how to look at these deals and what you're actually doing when underwriting it. But I always have to do a much deeper analysis because, for example, what we're doing right here is we're estimating that the expenses are between 40 and 50, and if you're off by 5 or 10%, it can make the deal go bad. And you just have to dig deep and understand each expense that goes into operating a property. Your number one job as a real estate investor is to mitigate risk. If you focus on mitigating risk, and that's done through understanding the numbers and understanding your level of certainty to execute the business plan and having the right team in place, that's your biggest risk when going into multifamily. So you have to protect the downside. And if you do that okay, the upside will always be there and you'll get wealthy over a long period of time. So now that we're off the whiteboard, let's do a very quick recap of everything that we just did, but simplified. It's a 28 unit deal in Ocala. It came out, we liked it because the guy had to sell. He was in default, so there was motivation, and he had to sell at a price that made sense for us. And then secondly, the value add portion to the deal, which allows us to increase the rents by almost $300. In the underwriting process itself, the first step that we did was we solved for the takeover net operating income by taking number of units times average rent times 12 minus our vacancy, and then we ran a 40% expense ratio, coming up with an NOI of $260,000. That was the income that we acquired, and after our renovations to the property, we increased the rents by $300 on a couple of units already, and so over the next 18 months, we'll continue that until it's completely done. And by doing that, we're increasing the NOI from $260,000 all the way up to $360,000 over that 18 to 24 month period. And then depending on where interest rates and insurance is between year 2 and 3 is going to be what dictates when we sell or do a cash out refinance. And after we solve for our future NOI, we're now able to look at the future value and dictate the returns, which in this case was above 20% per year, which in our eyes is a fantastic deal for the investors. And then the GP team personally picks up almost $500,000 in a fairly quick period of time. That is underwriting explained very simply on the whiteboard. Now going into the next video, this is the biggest barrier between where most multifamily investors get stuck at, because it's super easy to go from the whiteboard and then you get really stuck when you try to jump into an Excel spreadsheet and an underwriting model with line by line expense items and income. So if you're finding any value out of today's video or this entire series and you're learning exactly how to underwrite deals, I would encourage you to go to Crexi or go to LoopNet and just try to find a couple of practice deals where you can pull the T12 and you can pull the rent roll and start underwriting deals. It's just like working out in the gym. Whenever you go through the workouts over and over and over, it becomes easier as you do it. So if you found any value throughout the video, make sure you drop a like, a comment on what you want to see next, and most importantly, make sure you hit the subscribe button. And with that being said, I will see you in the next one.